Hi, this is Ida Puranik, and today I will be answering the top 10 most asked questions from our community about health insurance. Let's get started. How much health insurance do I actually need? Well, in most Indian cities today, 10 lakh is a minimum cover that most people should consider. See, a single hospitalization in a private hospital, especially in a metro city like Delhi or Mumbai, can easily cost you several lakh rupees in one go. So, if you live in a metro or if you just want more comprehensive protection, a cover of anywhere between 15 to 20 lakh plus a super top up is pretty common. Also, if you have a pre-existing condition like diabetes or hypertension or asthma, you should have an additional buffer of 10 to 15% more. Also, always make it a point to review your health insurance cover at every major milestone in your life. So, marriage, childbirth, it's time to review your health cover. See, medical inflation is very high these days, so a cover that feels very huge today may feel very tiny and inadequate 10 years later. And the goal of health insurance is not to pay your hospital bills only. It's to protect your savings and your investments from getting wiped out by a single medical emergency overnight. Is corporate health cover by my employer enough? Usually no. You see, employer insurance is very useful, but it disappears the moment you switch your jobs or you resign or you lose employment. It can also leave you without cover if you take a sabbatical or if you are in between jobs. See, most company covers these days are also quite low, often between 3 to 5 lakhs, which may not be enough today. Plus, if you want to cover your senior citizen parents, in most cases, employer asks you to opt for a co-pay option. Another issue with having just employer cover is that if you develop serious health conditions while being dependent only on your corporate insurance, buying personal insurance later on at later stages in life will become a very expensive affair. So, the safest option for you is to keep your own personal policy ready alongside your employer insurance. What is the difference between a top up and a super top up? So, your base plan is your main health insurance policy, and a top up policy activates only when the fixed amount, which is known as a deductible, which again is your base policy, is crossed in a single hospital bill. So, you have a 5 lakh base policy and a 5 lakh rupee top up. Now, if one hospital bill is 8 lakh rupees, the top up will pay the extra 3 lakh rupees and 5 lakh comes from the base policy. But if you have two bills of 3 lakh rupees and 4 lakh rupees each, a regular top up will not help because neither bills cross 5 lakh rupees individually. Now, a super top up is more useful in this case because it activates once your total yearly medical expenses and not just one bill crosses this deductible threshold, which in this case is 5 lakh rupees. So, say you had a total bill of 7 lakh rupees, the super top up pays the amount above 5 lakh rupees. Now, say you have multiple hospitalizations in the same year. You have crossed the deductible threshold and now all the expenses will be paid by the super top up. A super top up is more useful because it activates once your total yearly medical expenses, not just one bill, crosses the deductible threshold. So once your total bills become 7 lakh rupees, the top up pays the amount above 5 lakh rupees. You have crossed the 5 lakh rupee deductible threshold for the entire year. So now if you have multiple hospitalizations in the same year, your super top up will cover all these expenses even after your base policy has been exhausted. Which is why many people today combine a 10 to 15 lakh base policy with a 50 to 60 lakh rupee super top up for larger coverage at a lower cost, because both super top ups and top ups are very cost effective. You can get a coverage worth 60 to 70 lakh or as high as 90 lakh rupees for an annual premium of 5,000 or 6,000 rupees. Why are health insurance claims rejected? Tough one and a pain point for most people, but the biggest reason is non-disclosure. People forget or intentionally hide their pre-existing conditions like diabetes, smoking habits, blood pressure, or any previous surgeries they have. This can prove very problematic at the time of claims, and this is the single biggest reasons why policy claims are rejected. So even if you've had a mundane surgery 10 years ago, disclose it. Second, people forget about waiting periods for certain PEDs and make a claim during this time. Now, most illnesses are not covered immediately after buying the policy, and any claims during the waiting period are not acceptable. Also, certain treatments, consumables, procedures are simply not covered in your insurance policy, which is known as an exclusion. And if you make a claim on any of these, your claims will be rejected. These are the three main reasons why your health insurance claim is rejected. What diseases and treatments are not covered in my health insurance policies? See, largely everything is covered, but most policies don't cover cosmetic surgery, fertility treatment, self inflicted injuries or adventure sport related injuries, substance abuse related treatment, or experimental procedures. Pre existing diseases are also only covered after a waiting period, which, as per current regulations, cannot exceed 36 months or 3 years. Also, many policies have a limit on maternity, dental treatment, OPD, or other non medical expenses. So, this is why it's very important to check for exclusions because they matter just as much as checking the cover amount. What is a pre existing disease waiting period and how does it work? See, a pre existing disease, pretty self explanatory, is any illness that you had before buying the policy: diabetes, asthma, BP, thyroid. And insurance companies make you wait a certain time before covering these conditions. Under current regulations, this period cannot exceed 36 months, but companies offer a PED waiver, which you can buy at an additional premium and get down your waiting period to 12 months or 30 days. So if you bought a policy today, you disclose you have diabetes, and if you make a claim related to diabetes next year, your insurer will not accept that claim because typically waiting period for diabetes related conditions is anywhere between 1 year to 3 years. So always check for the waiting periods that every pre-existing condition has in your policy schedule before making a claim, and also remember to disclose all your pre-existing conditions honestly. What is a copay and why am I still paying from my pocket despite having health insurance? See, copay basically means that you share part of the hospital bill with your insurer. So, you have to pay a specified percentage of every claim you raise. And this is different from a deductible, which is the amount that you first have to pay out of your own pocket to satisfy the insurer's threshold. In a deductible, after this threshold is met, the insurer will take care of the remaining bill. For instance, with a 20% copay on a 5 lakh bill, you pay 1 lakh from your own pocket. In a deductible, if you have a deductible of 25,000 rupees on a 5 lakh rupee policy and you raise a claim of 5 lakh rupees, you will first have to pay 25,000 rupees out of your pocket and the remaining 4.75 lakh rupees will be taken care of by the insurer. See, copay is pretty common in senior citizen plans and cheaper policies. And a lot of people assume that insurance means zero payment, but copay clauses can actually create huge out of pocket expenses during hospitalizations. Yes, they come with lower premiums and so do deductible. Remember that both copay and deductible can significantly lower your overall premium that you pay annually, but if given a choice, always opt for a deductible in your health insurance plan rather than a copay. What is room rent limit and how can it increase my out of pocket expenses? Well, room rent limit is one of the most misunderstood clauses in health insurance. A room rent limit means that your policy only allows you to take a hospital room of up to a certain amount per day. Let's say 5,000 rupees per day. Now, suppose you chose a 10,000 rupees room per day instead. Many people will think that they'll only have to pay the extra 5,000 rupees difference themselves, but that's not how this works. Insurers apply something called a proportionate deduction. So, if your allowed room rent limit was 5,000 rupees, but you chose a room that costs double, 10,000 rupees in this case, insurer will apply 50% proportionate deduction on other linked expenses as well. This includes doctor visits, ICU charges, surgery fees, nursing and consultation charges as well. So on a 5 lakh rupee bill, the insurer may end up paying you almost half of what you actually expected, leaving you with a surprisingly large out-of-pocket payment. The fix is actually pretty simple. Take a policy that has a no room rent cap or a single private room eligibility, especially in metro cities where room costs are very high. Also, you can take a room rent waiver along with your policy as an add-on, which will also help you circumvent this room rent limit clause in your policy. What is cashless treatment facility and how does it actually work? Um, Cashless hospitalization basically means that your insurance company will directly settle all eligible medical expenses on your bill with the hospital directly. So you do not have to pay anything upfront to the hospital. But this only works in a network hospital, meaning that hospitals who have a tie up with your insurer. So when you get admitted in a hospital, the hospital sends a pre-authorization request to your insurer with all the treatment details and the estimated cost for the same. Now, if that is approved, the insurer will settle this amount directly with your hospital. But remember that cashless does not mean everything is free. Non-medical items, consumables, copay, or exclusions or expenses that are above your policy limit will have to come out of your own pocket. Also, many people assume that every hospital is cashless, but network lists differ from insurer to insurer and keep changing dynamically even within weeks. That is why before buying a policy, people should check whether any good hospital or their preferred hospital is actually a part of the network of insurers whose policy they are taking. And also, if you are planning an admission in hospital or if there is a planned hospitalization, make sure you go on your insurer's website and check whether your preferred hospital or the hospital where you're getting admitted is still part of your insurer's network. Should I buy my policy directly from the agent, buy it online, or from the bank? Well, all three options actually have their pros and cons. Buying online is usually cheaper because there is no intermediary commission and you can compare multiple policies in one go yourself. It works well if you understand insurance terms and conditions and are really comfortable reading the policy documents. Agents can be very useful, especially for first time buyers or families buying insurance for their elderly parents or individuals who want claim support during emergencies. In fact, a good agent can actually explain to you the clauses, the paperwork required, renewals, and help you with hospital coordination and claim settlement. Banks mostly act as distributors, so the convenience is super high because people trust their bank. But bank sold plans may sometimes be limited or expensive compared to buying directly from insurers. The biggest mistake that people actually make is that they choose their policy based only on the premium price. The important thing when you're buying a policy is not where you're buying it from. It's whether you understand the policy wording, waiting periods, exclusions, claim settlement process, and hospital network before buying. If you understand all this on your own, or if you think you need an agent to distill this process for you, that's your call. But the important thing is that you should have a health insurance.